Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. If you're an investor, you've probably heard of Warren Buffett, and a lot of us like to learn from what one of the best investors who has ever done it has said over time. So let's go back to a few of his favorite quotes and what we like about them. To do that, I brought on Jon Quast from Working Capital. You can find him on YouTube, Working Capital JQ. How are you doing today, John?
Hey, Travis, doing very well. In March of 2022, took about 2 weeks off from work and spent a lot of that time just thinking and studying Warren Buffett. You can learn so much from just looking over everything he's written and said over the last 80 years.
Yeah, no, you've gone through a lot of it. So I want to pick your brain. We're going to go through 3 of our favorite quotes and try to put them into context for investors today. Which one do you want to start with, John?
I'll start with the one that I probably go back to the most, and that is from the 1992 letter to shareholders, and I'll read it here because I don't have it memorized. We think the very term value investing is redundant. What is investing if it is not the act of seeking value at least sufficient to justify the amount paid? Consciously paying more for a stock than its calculated value in hopes that it can soon be sold for a still higher price should be labeled speculation. And so Buffett would go on to write, he's not a value investor in the sense of it has to look cheap from a price to earnings or a price to book perspective. It has to look cheap compared to what he's projected the future cash flows of the business to be. And so he might be looking at the cash flows 5 years from now or 10 years from now, even 20 years from now, and looking at the price today versus what he's reasonably certain he's going to get in the future. And that's how he derives value. If he can't make it make sense from today's price versus what the cash flows he's expecting from the business, then he doesn't invest. Otherwise, he would label that as speculation. So sometimes a stock can go up, and maybe it's because its valuation went up or whatever. And it might even be reasonable to assume that the valuation would go up or that somebody would be willing to pay a higher price. He considers that speculation, not investing. He's all about value investing, but he thinks that that term is redundant because he thinks all investing, by definition, is because you're getting good value for what you're paying.
Do you know anything about his process for trying to figure out what the correct value of a company is? Because I know that when he's bought private companies, he will do like a one price offer. I will pay you, I think See's Candies he bought for $25 million. And it was like, nope, that's my price. That's it. Take it or leave it. I have calculated this. And I imagine him sitting at his desk, just writing out like a simple model, but like not a model that you would build in an MBA class today where there's 47 tabs and you're trying to figure out how to recapitalize R&D. And this is all stuff I did in grad school. And I was like, none of this makes sense because I know at the end of the day, the model's wrong. That's the only thing I know about this model is it's wrong. So make it simple. And it seems like everything that he talks about is very simple, but I've seen some stories recently about how he decided to buy shares of Apple. And it was just, do we think this company can grow revenue at 7% or more over the next 10 years? And will we generate a return on investment of at least 13%? And both him and Todd Combs were like, yeah, why not? It was like, they kept coming back to it and going, yeah, this totally makes sense. And it wasn't, hey, we built this model and this is the intrinsic value is 20% higher than what it's trading for. It was just, hey, this seems really cheap based on the long-term trajectory for the company. And it's almost like simplifying things that we try to make really complex. Or do you have any more insights into how he actually mechanically does these things?
So I do know for a fact that he tries not to listen to anyone else's opinions when it comes to deriving these cash flow valuations. Particularly, he's not looking at what the analysts are saying. He's not looking at what economists are saying. He's not looking even a lot of times at what the management is saying, because by definition, the management is going to be probably pretty bullish about their business and but often perhaps unjustifiably bullish. And so he is definitely looking at his own numbers for sure. And that is why he's so keen on sticking within his circle of competence. He'll say often, this looks like a good business. I don't know how to project any sort of cash flow assumptions with that, so I'm not going to invest. And What about this other person? He is good at this business and he does have a cash flow projection. Doesn't matter. If I can't do it myself, I'm not investing. So I think that is why he sticks to a lot of boring businesses in many ways. They're not, I don't think he's invested in anything that's splitting the atom. It's Dairy Queen, right? It's a furniture store. It sees candy. This is pretty basic stuff to be able to have a reasonable conviction on what the cash flow is going to be. And the other thing that I would say to that is he's talked about this before about a margin of safety. So it doesn't just have to make sense from a marginal standpoint. Like it's going to have to return 15% a year to be a good investment. And we think that it might be able to do 15.5%. No, it's like it needs to do 40% a year. And if it does 15, we'll be okay. So it's so much more beyond what he's assuming is going to make it a good deal. That's the margin of safety. So it does make it a no-brainer in many ways. It's, oh, wow, even if this company's screwed up here and here, they're still going to produce enough cash flow that's going to more than satisfy what I just invested. So it is an oversimplification in many ways. And at the same time, there's a beauty in that.
Yeah, I like that one. And it'd be fascinating to get into his mind with how he thinks about some of these investments. The quote that I wanted to go with is just a simple one, but it's one I almost have to remind myself of on a regular basis. And that is rule number 1, never lose money. Rule number 2, never forget rule number 1. And I think some of the things that he says, they're almost like contradictions to the way he actually invests, because he has lost money. He has made poor investments. He's gone time and time again back to the airline industry and lost money in the airline industry. He's gone back to the energy industry now, oil and gas. We'll see if he continues to make money there or if something has changed fundamentally. But I think the way that I interpret that is you want to go into an investment not thinking that you're speculating that some sort of home run is going to happen. You're going for a single, and if you hit a double or a triple or a home run, great. But that's not the intention. The intention is to make a really good, sound decision. And one of the things that I've learned over time with myself, I've been investing for more than 25 years now, is I am most comfortable when the market is down bad. So I remember in 2009 sitting and doing the math on, wait a second, Apple, who has this incredible product called the iPhone that they're selling like crazy. They're continuing to grow at a just tremendous, tremendous rate. Despite the fact that we have this great recession, they have a ton of cash on the balance sheet. They were trading at, I think, 8 times cash. And I was just going, what am I getting wrong? Why is this seems too easy? And it's like, if you can do that over and over and over again, and if you can make 10 investments like that, you're not going to get 10 right. But in the aggregate, you're going to get a lot of them right. And if one of them becomes Apple, now you have a tremendous performing portfolio over the next 10 or 20 years. So it's not that you have to make money on every single investment that you make. It's that if you have sort of that mindset that keeps you out of speculative investments, this is one thing that I need to learn, especially after the last 2 or 3 years, is not to chase things that are maybe potentially really revolutionary long-term, but are really high priced. And I'm not getting that value that I can go, gosh, why is this so cheap? Because there was almost nothing over the last 2 years that was really cheap, unless you were in the oil and gas space or something like that. But I think that's just a mindset thing that I need to keep coming back to and remind myself from a first principles basis. What's the final quote you wanted to go with, John, to end us up?
So I love this quote from Warren Buffett. It's not actually original to him. He's quoting Samuel Johnson, who was a guy in the 1700s who did a dictionary, I believe. But the quote is, and he wrote this in his 1985 letter to shareholders, "A horse that can count to 10 is a remarkable horse, but it's not a remarkable mathematician." And that is such a funny quote. And he was saying it, though, in the context of the textile business. And so if you know the history of Berkshire Hathaway, a textile company, and he has often talked about how that's actually one of his worst investments, because as he took over that company, they invested more and more money to be the best textile business that there was. And yet that was a failing industry. It was cheaper to do textiles in China, so nobody was buying from the textile companies of New England. And even though Berkshire was running itself as good as it could, it was just a dying industry. And so that really wasn't a good place to be putting your money. So that is what was going on with that quote. Berkshire was a remarkable horse, but it wasn't a remarkable mathematician. In other words, there can be companies that are doing very well relative to all the other companies in their space, relative to their peers and rivals. It's the best in class, it's the top dog, and yet that is not a space that you want to be invested in for one reason or another. So it could be that it's dying, it could be that the economics are inherently bad, but it's a good reminder to me, you're looking for not just the relative performers, not just the relatively good business, but the actual good business, no matter who you're comparing it to.
Yeah, it's kind of like investing from an industry or macro level versus just an individual stock. Sometimes I talk about I'm bullish on the solar energy, or I'm bullish on cloud computing, or something like that. It's okay to just say, these are the 3, 4, 5 best companies, and I'm just going to buy an equal amount of all of them because I don't know which one is going to be the one that's going to succeed. But I know somebody is probably going to succeed in there. And a lot of times that ends up being the right strategy because you end up overthinking yourself by, trying to pick the one stock in the right industry and you get something wrong. So I really like that one. Hopefully these quotes have provided a little bit of perspective and we can provide a little bit of context to how to think about that with the market today. Appreciate you watching. Leave any comments you have or any quotes that you like from Buffett in the comment section below. Follow Rive Investing and Jon's channel, Working Capital JQ. Thanks for watching. We'll see you here next time.